Another method is income statement approach. This approach we use percentage of credit sales. The company may estimate what percentage of credit sales will become default or finally become bad debt. This method is provide the direct amount of adjustments. For example, if this company had sales 1.2 million, estimate 2% will be uncollectible. So the product of these two numbers was 24,000. And this is just the amount of adjustments. We just debit bad debt expense, credit allowance for doubtful accounts, 24,000. Different from the balance sheet method, which determines the ending balance of allowance for doubtful accounts or an allowance for uncollectible accounts. Income statement approach provide a direct amount of adjustments. Also, the textbook provides us combined approach for both balance sheet and income statement methods. You can take a look by yourselves. In this example, we're given there was a credit balance $10,000 in the allowance for uncollectible accounts. So you may use a tier account. So here, this is allowance for uncollectible accounts, okay, to be simple. We are given the beginning balance was $10,000 credit, so we put the number on the right. And also, we are given by the end of using aging methods, by the end of this year, credit balance $5,000. Okay, we don't calculate, we're just given the ending balance of this account $5,000. And during this year, the company also wrote off $200,000 bad debt expense during this year. What's the journal entry of write-off? This is the journal entry of write-off. We debit allowance for uncollectible accounts and credit accounts receivable. Since we only investigate these accounts, so a write-off journal entry, there will be a debit to this account. For this particular example, there was a debit $200,000 on this account. And actually, for the journal entry, the company also credited accounts receivable. So here, we have these three information: beginning balance, ending balance, are written off. Then, what's the adjustments? Adjustment actually is $195,000. The calculation is beginning credit balance, subtract $200,000 debit, then make another credit adjustment, ending balance is $5,000. So using these three information in the T accounts, we can determine the adjustment was credit to allowance for uncollectible accounts. At the same time, we will debit bad debt expense. Actually, if you put this adjustment into this T accounts, so the total credit was $205,000, debit $200, ending balance will be $5,000. So the answer is A. Yeah, this method actually also it is a balance sheet approach.